Hey guys, what's going on and welcome back to my YouTube channel. My name's Luke and I talk about all things property, investing and renovations. And in today's video, given that we're coming up to the end of the financial year for 2021, I thought it'd be a great time to talk about the 7 tax advantages to having an investment property. So these are things that you can claim as deductions and the tax benefits that you can get from having an investment property. I'm going to break them down and provide insight into how they might help you save some money at tax time and put more money in your pocket at the end of the day. Now, before I jump into these 7 areas of tax minimization, I am a chartered accountant, but this is not financial advice. You need to speak to a tax accountant that is doing this work specifically for you. This is just for educational purposes and putting this out there on YouTube for discussion. So item number 1 is depreciation. And this is a great way to save money at tax time. You can go to a depreciation specialist, such as BMT, and for a few $1,000s, they'll give you a depreciation schedule, which you can give to your tax accountant at the end of the financial year and claim potentially thousands of dollars in savings at the end of tax time and get a tax refund potentially. Now, using depreciation can potentially turn a negatively geared property into a positively geared property. Now, a negatively geared property is where the revenue or the income from your rent doesn't cover the expenses and interest repayments on your property. Now, once you claim the depreciation and you get the additional benefit of that, it might turn your property into a positively geared one, which means that all things considered, the rental income plus the tax benefits, it covers all of the expenses on your property. And this can be a great way to hold a property without chipping into or taking away from your lifestyle options. Point number 2 is negative gearing. Now, this has been a widely talked about topic. It's very hot with both of the political parties, and I don't want to get into politics, but essentially negative gearing allows you to claim the losses that you make on your property portfolio as a tax deduction against your personal income. Now, before you go and claim these losses against your personal income, again, see your tax accountant who can give guidance and understanding to the specific negative gearing rulings and can process that for you in your tax return. But at the end of the day, you want to try and make money, not lose money. So don't go out there with the mindset of great negative gearing benefits, because they might not be here forever. And it also means that you're not really making a lot of money out of your property portfolio. You're making a loss. You're trying to run your real estate investment as a business. So if you have been making a loss, by all means claim the tax deduction, but it should be an afterthought. It shouldn't be part of your strategy to try and make a loss out of your property portfolio. Take the benefit if it's there, but otherwise try and make sure that your property is neutrally geared or positively geared instead. Now, number 3 is claim the interest expense on your investment loans as a tax deduction. This is the number 1 expense that you're going to have in your property portfolio. You're going to be taking out hundreds of thousands of dollars worth of debt from a bank or in a financial institution. It just makes sense to ensure that you're claiming these correctly. Now, something to be wary of with claiming the interest on your loans is you can't claim the principal component. So if you're paying principal and interest on an investment loan, you can't claim the principal pay down on that loan as a tax deduction. You can only claim the interest component. So just be wary of that when you're looking at your investment loans for tax time. Number 4 on this list is claiming land tax as a tax deduction. Now, not everybody out there is going to have to pay land tax, but once your portfolio gets to a considerable size, that's going to mean that you have to claim and pay land tax to each of the state governments depending on whether you're over their thresholds or not. Now, land tax can be mitigated by investing in multiple states and buying potentially in your personal name versus in trust structures. I've talked about buying in personal names and trust structures in another video. You can check that out in the description down below. But essentially, you can reduce your land tax bill by buying in multiple states across Australia. You could buy a property in Queensland, a property in Adelaide, a property in Sydney and in Melbourne. So you're buying in each of the major states, and that's going to spread your risk through diversification. And it's also going to reduce the likelihood that you have to pay land tax, as there's typically thresholds in place in each of the states of where you'll start being charged land tax. So just keep that in mind, that you can claim it as a deduction, and it can also be mitigated by diversifying where you buy property across Australia. Now, number 5 is a big one, and that's claiming agents' fees as a tax deduction. Now, not everyone out there uses an agent. Some people self-manage their properties, but using an agent can be a really good idea to make your property portfolio more passive and to be able to rely on their expertise to keep the property well managed and looked after and collect the rent as well, which is very important. So all the agent fees that you pay as an investor to your manager are tax deductible, and I would highly recommend that you leverage and use an agent when investing to de-stress your portfolio and also claim it as a tax deduction. Now, number 6 is a bit of a hairy one, and that's repairs and maintenance. Now, I'm not going to go into too much detail in this video on what specifically is repairs and maintenance, but I'm going to provide you with an overview of the high-level concepts. Now, you can claim repairs and maintenance when you're turning something back into its original condition. For example, say you had a chipped tiles on your floor or plumbing leak that needed to be repaired. That leak and the cost that you pay the plumber is tax deductible because they're repairing something that's there. Now, where it gets a bit more difficult to work out whether you can get a tax deduction or not is if you're improving what was already there. So for example, let's say you pulled out the old tapware and had the plumber install brand new taps. You're not going to be able to claim that as a repairs and maintenance deduction. So talk to your accountant about the specifics of what you can claim, and make sure you keep all your records from your agent, or if you're managing yourself, keep your records safely so that when tax time comes around, you have copies of all your invoices ready to claim the maximum deductions on your repairs and maintenance at your property. Now, in my opinion, it's a great idea to spend this money on repairs and maintenance. It's a headache for a lot of investors to spend this money, but to keep your tenants happy and to keep the property in a good state and not in disrepair, it's a great idea to spend the money on repairs and maintenance when you have to, and also claim the tax deduction for that expense. Now, number 7 is a massive one, and this is the capital gains tax exemption. Now, this doesn't specifically relate to everyday income tax return that happens from owning a property, but this is evident when you sell a property. So when you're going to sell your property and make a capital gain, if you own the property for more than 12 months, you can claim a 50% CGT discount on that property, which is going to save you a bundle of tax when it comes around to tax time for that financial year. So if you bought a house for $500,000 in Sydney 10 years ago and you sell it for $1 million, instead of paying tax on a $500,000 gain, a 50% CGT discount would allow you to pay tax on only $250,000. Now, when you're selling a property, it's a great idea to have a chat with a trusted advisor or a tax accountant that can help you understand the best way to structure and sell your property. Getting and claiming the maximum capital gains tax discount that you're allowed is a huge way to save money when you're looking to exit a property and realize the returns that you've made over time. And there are plenty more tax deductions out there. These are the 7 critical ones that I wanted to discuss in this video. If you'd like to hear more about tax and property, you're a weird person, but leave a comment down below and share your ideas with me in the comment section. If you made it this far through the video, I really appreciate it. Drop a like on this video and subscribe to the channel. I'll see you in the next one. Peace.